Now, here are your hosts, Dominick and Michael Hartzman.
All right, I'm Michael Hartzman. Today is Tuesday, August 29th, 2023. And I'm on, as always, with my partner, Dominick, both of us live from Long Island. How are you, Dom?
Doing well, Mike. I have no complaints other than the summer days are getting shorter here, and we'll be flipping to fall pretty soon.
Yeah, we'll be doing this podcast with the sun going down over our shoulder before you know it. But let's hold on to summer for as long as we can.
One long weekend ahead, at least.
Exactly. And you know what? We've been spending a bunch of these last few shows talking about August and July and how they're a little lazy and a little slow and the market could be a little sloppy. But I saw a statistic this morning, Dom, that I was a little surprised at, that through Friday's close, the S&P was basically flat. Through July 1st to last week, the S&P was only down 0.75 of a point. And the NASDAQ, Dom, was only down 1.3%. And I bet you, if you ask the average investor, they get the sensation that the market was down or has been down a lot more than it actually is this summer. Just feels different.
Yeah, Mike. So the dates you rattled off is looking back over a 2-month period, and what we know is that July was a pretty good month for the markets, and pretty much for now, the year high was on the last day of July, and then we've given a little bit of it back this month. Not much, to your point, Mike. I think the major indices through Friday were down 3-4% for the month, but certainly nothing catastrophic. But the headlines have a lot of the quote unquote experts talking about a pullback in August, a possible pullback in September. And so the headlines have possibly frightened some people out there.
And there's always a possibility of a pullback in August, simply because, as I said earlier, there's not a lot of volume in August. So depending on the trading trend, if there's not a lot of support on the other end, then the selling kind of creates selling because of very little volume. But to your point, Dom, I don't think the VIX, the volatility index, I mean, it's been up a little bit since the July high, but it really has been pretty tame overall for the month.
And you can argue, Mike, that considering what interest rates have done in the last couple of months and gone from the 10-year from about 3.4% today, about 4.2, that's a pretty big move in terms of interest rates. You would have thought the market would have given back a lot of this year's gains. And like I said, we've seen a little bit of a pullback in August, and maybe we see a little bit more in September, but the market has digested this data pretty well, and I think is holding up respectably well.
Yeah, so just a little context, on July 1st, the VIX was trading at 1445, and that's an indicator of volatility and how active trading is and sentiment in the market. It did hit a high in August 18th of $18, which is a pretty good move. But now it's right back to 1445, Dom. So yeah, it's settled back down again. It just seems like right now the market and people in general are taking a wait and see approach.
And some of that is exactly what you pointed out, Mike. We joke about it, but a lot of people do take the summer off and or work less hours in our industry. Certainly Fridays and Mondays, there's less volume out there. So any noise at all will move the market a little bit more on the upside or a little bit more on the downside. But I still am going to come back to this theme that considering how much interest rates have gone up and what Fed commentary has been coming out, I think the markets have held up reasonably well. And even if we were to go through some volatility over the next month, we certainly don't expect anything really ugly.
And to your point, if we really think about it, Dom, in the month of August, one of the leading candidates for president of the United States has been arrested twice. Not arrested, indicted, forgive me. He was indicted twice. There's news that COVID is popping up again, and there's a new strain. right? So under normal circumstances, there's clearly things that you could worry about or be distracted about. And Dominic, the market is basically ignored all of that. All it seems to focus on is what you just said. Interest rates. It's all they care about.
And to be fair, Mike, in that discussion, earnings have held up pretty well. One of the giant tech companies just reported monster sales and profits. We have not seen the collapse that some of Wall Street big shots had been predicting. We're talking about it in earnings. Just hasn't happened. And in fact, you can argue earnings forecasting has improved. And a big one is inflation, although not dramatically lower, is still trending lower. And that means at some point the Fed is probably going to pause their interest rate hiking policy.
Let's talk about inflation for a second, because you and I are on the phone all day long with our clients. And I've noticed lately, if I really want to frustrate my clients, I'll tell them inflation is coming down. And I have to tell you something, they are not happy hearing that. They don't believe it. They don't feel it. I don't know if you get the same reaction I do.
Well, if I can pretend to be one of your clients, Mike, and I think this is a really important point. The rate of how much stuff is increasing is coming down, but prices are still higher today overall than they were a year ago, than they were 2 years ago. So the prices are not going up as much, if I can be so blunt about it, but they're still way higher, and we can point to specific parts of the economy, and that is painful to people's budget, Mike. And I agree with you. You're absolutely correct. Inflation is coming down, but prices are not. We're not at a stage yet of disinflation.
Correct. As you know, I would quote my late dad, and he would call me college boy when I pointed out the obvious, and he would say to me, well, the inflation may be coming down, but things are still expensive.
Yeah, and I don't have the time. We don't have the time to do this right now, but a mutual friend of ours sent me a little printout of the price of flank steak over the last 2 years. And that says it all. I know all the brain surgeons get on TV and all the politicians get on TV and talk about how inflation is lower, but all you got to do is look at the price of flank steak, and that tells you all you need to know.
And I happen to know you like a good flank steak, so I'm
a steak eater, absolutely.
Right. So speaking about things being expensive, tonight's guest is Jordan LeWinter, who's a friend of ours. He's actually an associate of another friend of the show, Harold Balachi. He's a young attorney. We've known him a long time. He's helped a lot of our clients. And what we wanted to do is bring on someone who lives and works on Long Island, who was raised on Long Island, plans on starting a family on Long Island, and how difficult that actually is in 2023.
Yeah, and Mike, if I could just add to the story. So, we're constantly, most of our clients tend to be post retiree. So I'm going to say in that 55 to 65 age group, obviously older and younger, but the core in that age group. And here's a younger person, a professional who's dealing with a kind of a different set of problems and issues from wealth planning perspective. So it's nice to kind of get a different voice in our head here about what's going on in the real world.
Absolutely. So Jordan will be joining us, and Scott, my son, will be joining us. He's Jordan's age, and they could add a little perspective and context. So we'll be right back with Jordan LeWinter and Scott Hartzman in a few minutes.
Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with my partner Dominick Tavella, and our special guest this evening, Jordan LeWinter, and also joined by Scott Hartzman. Hey guys, how are you?
Good. Thank you very much, Michael and Dom, for having me on the show.
Welcome to the show.
Thank you.
So Jordan, I'll give Scott a little credit. It was actually his idea that this should be the theme of the show tonight. And we immediately thought of you. You're a young professional. You were born and raised on Long Island. Your parents still live on Long Island. I think your fiance is from Long Island as well, correct?
Everybody's from Long Island.
So,
Great.
so when you and Sam decided to get married and buy a house, did you ever seriously think about not doing that on Long Island?
Seriously think? No, but for a hot second, it came into our minds that Florida was looking good. What we always say is if we could be snowbirds today, we would. If we can do the 6 months now and go back and forth, we would. But careers, family, school districts, life is just here. So seriously, no, we couldn't go, but it does come into our minds every once in a while.
See, Dom, I told you he's an old soul. He's a 28-year-old snowbird.
And that's some front lawn he's got behind him.
Yeah, it's I think that's
Uh,
Capital
it-
and Maui.
In all seriousness, Jordan, and again, I have children your age as well. We typically are talking to myself and Michael talking to a client who might be 60, 65 years old, and they've owned a home on Long Island for the last 20, 30 years. They paid off their mortgage. So from a wealth planning, financial planning picture, it's pretty sound, right? But for a young person today and we're picking on Long Island, but it could be Chicago, it could be California, it could be any one of these major cities where real estate prices are high. And unfortunately, so are mortgage rates today. What are you doing about it? What are you thinking about it?
It's tough. When we were looking to purchase a house, for me, my entire life, I grew up in a family that was investment first and then liability second. I was always raised, put the money away first. Do not spend the money that you're making to go buy something flashy or something like that. Put it away, let it grow. One day you're going to need a down payment for a home. What I didn't think about growing up was that how quick the prices of houses were going to go up. I have this conversation all the time with my family is that the increase in value of property from when we're looking to buy property compared to when they were looking to buy property in comparison to salaries is significantly different. I don't recall the exact figure, but when we were going through it, it was sometimes 10 times the salaries for us now to purchase a home than when it was for my parents to buy a home in the same neighborhood. When I was looking to purchase a home with my fiance, we thought of a couple of things. Mainly, what do we want our monthly payment to be, and how can we keep it there? Going with what you were saying, Dom, with interest rates, we're in an interest rate of 6.8%. That's very high. I know many people in my parents' generation and the older generation will talk about, they had 18% and all these things, but the prices of houses are now 5 times the amount of money. And like you were talking about before, flank steaks are 5 times the price, of living. So that's the first thing we looked at is, where do we want to be? Because I was taking money out of investment accounts that I've had to move into another asset. So it was first find out where I want to be. What do I want my monthly payment to be? And how much money do I have to come up with to make that monthly payment in terms of a down payment? From there, we would go look in the neighborhoods and figure out if this was going to be a starter home or a potential long-term place to stay. For me, compared to my fiance, Jen, I look at whatever I was going to purchase as something that I can get money out of. Whether we're there for a year or whether we're there for 2 years, I have options with where I purchase. I have options to rent it. I know being a landlord in New York now is a completely different world. But I also have the ability that with the down payment that I had to put down to get to the monthly expense that I wanted to be at, the monthly mortgage, that I can refinance the home when interest rates go down. I wasn't deterred from the interest rates, believe it or not. What I looked at it as an opportunity, very different than a lot of the people my age that I talk to. Everybody I talk to now is, I'm going to wait for the interest rates to go down because the prices of homes are going to go down. Like you brought up, Dom, Long Island, Chicago, California. Through my work, I don't see it. I don't see prices coming down here that as much as maybe the national rate, as everybody's talking about with interest rates coming down. I only see the frenzy starting up again, the lines out the door. So, I wasn't really deterred by the interest rate. I'm like, if I found a home that was acceptable, everybody looks for a bargain. I look for acceptable. What can I acceptably pay for this house? And that's kind of how we approached it.
In Jordan, to your point, home prices and interest rates are a seesaw. So the truth is, you're right. If interest rates start to go down, that'll give sellers a reason to raise the price a little bit more, because most buyers who do it right do what you did and kind of work backwards and try to figure out how much can I afford. So let me ask a question to you and Scott. Are you the outlier? Are you an anomaly? Or a lot of your friends right now buying homes and planning on getting married and starting families, or are you and Jen, the outlier?
I feel like in my case, Jordan is my only friend right now buying a house and planning a wedding. All my other friends are at home, living at home, are single, and we really have no plans of moving out anytime soon.
I would say I'm very lucky. I have a fiance that is able to tolerate what I do and the hours I work, and really trust my judgment when it comes to these things. She's a CPA and accountant as well, so she kind of understands kind of the end goal and how we never saw ourselves renting. So we always looked at as renting as money that we could be using to do other things. But we were also very fortunate to grow up on Long Island and have parents that would let us stay home for a longer period of time than some people are afforded. So I would say we're probably the outlier. I have a friend or two that is getting heavily involved into real estate at our age and understanding the opportunity now, like you were talking about, Michael, about interest rates being high, homes still being fairly high compared to what people expect. But I think what people expect is kind of gone. I think those homes in Plainview and Syosset for 300,000 or 400,000 are just never going to exist again. No matter if interest rates go down to 3.5% again.
So Jordan, if you don't mind me interrupting you, I don't think we disclosed that. I think, and correct me if I'm wrong, you're an attorney as well, right?
Yes.
So just put your attorney hat on, because I don't want to put you on the spot.
Yeah.
But many of our clients, and you brought up two issues. One, they're living longer with their parents, so that maybe they can save up some money, and then the parents are helping them, i.e. with some money to help with the down payment. So put your attorney hat on. What are you seeing in terms of younger people being able to, and how are they able to afford to go out there on their own?
From what I noticed from closings that I do for young people, they are getting, especially around here in Long Island, I'm not saying it's for everybody, but they are getting help from their parents. I was given help from my parents in multiple ways. They helped me out with some cost in closing. They've helped me out by letting me live at home and give me the ability to save. I think that's really a big thing for a lot of the young people that I see, that I represent, is the ability to save and understand the value of a dollar. Most of the people that I represent that are within this age group of 25 to 35 even, their focuses are very different. Their focuses are more on saving, rather than they're willing to forfeit that extra vacation a year to put away that extra month's salary. I think they understand where life is going. They understand kind of what we were talking about, the frenzy. Everybody talks about the frenzy and the lines out the door. So they're willing to get that help from their parents and put their pride aside, a lot of people, and say, okay, I know a year or two from now I'm going to be in a better position because I did this now rather than wait.
So Jordan, I know you went to LIU and Hofstra, and I know personally that how expensive that could be. And for the two of you, I know you both went to high schools that very proudly boasted that almost 100% of their graduates went on to college. So college is super expensive. So how does a normal 28, 29, 31-year-old, if they didn't get support from their parents, if they didn't get a scholarship, how are they paying student loan debt and buying a home and starting a family and staying on Long Island?
I was going to say, I think that's why a lot of my friends too are not starting families and not moving out because they have student loans. Especially with the student loan pause, a lot, now that it's starting up again, nobody's focusing on moving out at the moment. They're putting all their income back towards student loans.
Yeah, and I find a lot of people that I talk to, friends of mine, colleagues, they look at debt wrong. You guys would be more adverse on this, but the way that I believe most people look at debt is that, okay, we do have these loans, we do have these expenses. A lot of people, and Scott, correct me if you see it otherwise, they look at it as, okay, I already have these $100,000 of debt. Let me go ring up now, $20,000 on a credit card. Because they already think there's so much in a hole, rather than taking that $20,000 or whatever the amount is that they're making or spending and putting it towards something that can get them out of that debt or generate some more income for them to move out of that debt or to get themselves on their feet to be able to start a family and purchase a home. I think a lot of people's misconception too about purchasing a home is they need to have a lot of money up front. I find that through my experience at work, it's just not always true. There's a lot of programs out there for first-time homeowners that can get them still a 3.5% down payment and not have to come up with 20%. And then a lot of these kids are still spending $3,500 a month, $4,000 a month to live in an apartment and renting and not having anything to show for it. People also look at mortgages, I believe, wrong. Like I said, I'm carrying a 6.8% mortgage and I had to come up with a certain down payment to be able to carry a mortgage payment that me and my fiance found palatable. But down the road, we can refinance the house and take the money out of it, and we could take our down payment out, either invest it or purchase a new home. So I think a lot of it is people looking at debt wrong, Michael, when people are looking at those student loans and they're looking at, a lot of people like to, I don't want to say complain, but because I may not have been in their position because I did get help. But I think they look at it wrong. I think they look at it as, an issue, and they, rather than us looking for solution.
And Jordan, you brought it up, so you stole my thunder a little bit, but we keep talking about purchasing a home, but in fact, rents out there are equally as high, outrageous, overpriced. And so sacrificing a little bit, staying at home, that means both the parents and the child, right? You don't have necessarily the quality of life that you want, but doing that sacrifice short term financially could have huge beneficial implications later on.
Absolutely, Dom. What I said, and I wrote it in my little notes too, is I used to think everything has to be done in your 20s. It doesn't. I think that was a really big thing that I learned. Something I've been saying a lot recently is that I used to dream 10 years ago, me used to dream about what I have now, and I don't sit down and think about that. I always thinking about what's next. But I realized the truth is I'm 28. Everybody thinks they have to conquer the world in their 20s. You guys could probably speak about that more with the successes that you've had. It's just not true. Patience is key. Staying home that extra year or two and not spending $30,000 on rent could be your down payment for a home to carry the same rental payment.
Or pay down your loans by $30,000.
Or pay down your loans.
Significant cash flow implications going forward.
Absolutely, and cut that interest down. 100%.
Hey, Jordan, let's do this. You guys are doing a great job so far. Let's take a quick break, and we'll come back with Scott Hartzman and Jordan LeWinter, our guest this evening, talking about, living and staying and raising a family on Long Island. So we'll be right back.
Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with my partner Dominick Tavella and Scott Hartzman, and our guest this evening, Jordan LeWinter. So, Jordan, let me ask you this: what's the next thing for you? You know, as you grow your family or you start your family, what's the next challenge, and how is it different? Do you think for you than it was for your parents when they were in the same spot, say 30 years ago?
Absolutely. Right now it's me and my fiance, and those are the only two people we have to worry about. As we start to bring in kids into the picture, hopefully one day. That's another mouth or a couple of mouths to feed. And as you guys were talking about before, inflation is high, but maybe coming back down a little bit, but still expensive. We were talking over the break that it's every time you go to the supermarket, it's $300 and we still have nothing to eat. For me, what the next step is staying disciplined. Something that I was always taught, from my grandfather as people's salaries go up and their earning potential go up, their liabilities go up. As people tend to make more money, I find, especially with our generation, Scott, they spend more money. They get a nicer car.
Mm-hmm.
They go on a nicer vacation. What's next for me is understanding that as my earning potential may go up, to be able to keep my liabilities the same, which gives me the ability to have a safety net, and put money away, either invest in the stock markets or invest in more real estate, as I believe real estate going forward is going to be a great investment. But that's really going to be the biggest goal for me, is understanding what the next 10 years may show with starting a family, planning a wedding, maybe needing more space in my house, is as my income may increase, to be able to keep my liabilities and my expenses the same, if not proportionally just a little bit higher as life changes and inflation increases.
So, Jordan, we're used to, again, we do work with quite a few people your age, but the majority, again, tend to be a little older, and they're looking at retirement, and maybe they are retired. I'm kind of curious, as a younger person, how do you look at things like the stock market or Bitcoin or SPACs or these arbitrary, maybe more speculative type investments? How do you think about them? And do you think about retirement at this point in your life, or that's just so far off that, gosh, can't worry about it right now?
No, I've been thinking about retirement since I've been 10 years old.
You truly are an old soul, but go ahead.
I've been thinking about retirement. I've been investing since I've been a very young age. Great question about, the new tech stocks, the Bitcoin, stuff like that. I think it's good to have it as an option, to be involved in it, to dabble in it, I like to say, but not to put all your eggs in one basket. The way that I like to look at investment is buy companies that are going to be around longer than I'm going to be here. Or companies like these new tech companies that we talk about that you see on Reddit that are going through the roof and people are saying, bring them to the moon. I find them bad, but I find a lot of people are getting involved and they're infatuated with the get rich quick. I believe, like we were saying before the break, that it all doesn't have to be accomplished in the 20s, in your 20s or 30s. It's important to be diverse. It's important to invest in some of these tech companies, but understand not to put all your eggs in one basket. Understand that boring works. Somebody told me that one time, and it stuck with me. Boring works. The S&P works. ETFs work. Most individual stocks, correct me if I'm wrong, wind up going down in value over the long term. I could be wrong on that, but I heard that somewhere. So just understanding not to just ride the gravy train. Understand going in, if you're going to go in. If I'm going to go into one of those stocks, like a GameStop or something, have an exit strategy. Don't be greedy. Take your couple of points and get out. And then understanding taxes and, having to redeploy that money, minimizing some tax exposure and some volatility exposure.
So I'm glad you mentioned GameStop. That was a phenomenon that basically started when Dominic and I started our podcast, and we spent a lot of our first few shows talking about that. And I want to, segue that also into things like Robinhood and even online gambling, because the frustration that we have as older investors and older financial professionals, not that old, but definitely younger than you two, is people were almost looking at a stock the same way they will look at at a betting line before the Knicks and the Bulls, play. And it's not a strategy, right? And that makes it literally a game or a challenge.
Yeah, it's the online betting. It's in our faces everywhere we look, everywhere we turn. It's like these stocks. I think a lot of it with our generation, Scott, is a lot of it's get rich quick. I've always taken the patient approach, understanding that it does not happen overnight. But I can't sit here and say I haven't invested in Bitcoin like Don brought up and some of these other cryptocurrencies that probably won't exist in a couple of years. I don't find them bad. I find divulgence bad. I find putting everything into one thing bad and expecting immediate results. It's just not the way that I've been. It's not the way I don't think Scott is. But I find it dangerous. I find it very, very dangerous because the money that I know of people are betting with and investing with. I think a lot of people are investing in these things on margin, not understanding what margin is. A lot of people are betting to get out of previous bets that they've made that have gone bad. It's a slippery slope. And this is all money that they could be putting away to start investing into safer things, or putting even, a money market account to increase some interest to get a down payment. I find it very dangerous and very, very much a slippery slope.
So, Scott, I want to drag you into this one because you wear two hats in this conversation, right? You're a young person, but you're also an advisor. And I've had young people come up to me and they show me their phone and they have a Robinhood app where they're trading some crypto, and then right next to it, they'll have a DraftKings or some other betting app, and they equate the two almost exactly the same. Yeah, and I'm trying to make this argument, I do, but I'm an old soul, where, hey, that's not investing. And if you enjoy it, great, God bless. I'm not here to judge you on it, but how do you deal with that, Scott, as a young person, but a young advisor?
There's like two ways of seeing it, because I see people want to have money to play with if it's just money they got, to invest and see how it does. I had friends in particular that invested, say, in GameStop, where they told me, like, look, look how much money the stock popped. Then, a few months later, they showed them the same stock that, wow, look how much money I lost. So it's the same time, like Jordan said before, you take your wins, if you have the wins, and diversify it out into different stocks or ETFs or mutual funds, or even just retirement accounts. A lot of my friends are not investing at all in retirement accounts. They're working, there are companies that offer 401ks and not investing in it, or they have companies that don't offer 401ks and not even investing in retirement accounts. So it's just trying to, as Jordan and Michael and Dom have said plenty of times before, is diversifying your assets.
I also find too, Scott, you brought up a good point. Too many people, like you talk about the GameStop going down, too many people our age invest with money that they need. I've always been taught invest with money that you don't need day to day. And I think that's what gets
right.
a lot of people our age in trouble. They'll be like, oh, I got to take my rent money and put it on GameStop. I think people need to start, especially our generation. It comes back to the patience thing and the discipline thing. Don't invest with money. This is my method. You guys, everybody has a different method. I don't invest with money that I need day to day. I don't invest with money that is going to go towards my mortgage or my landscaper or groceries or even just to play around the golf. I think that was a big issue when that GameStop thing was going on. People were investing with money that they needed. People are gambling with money that they need, and they think the only way out when they lose is to re-gamble and re-bet.
And it's the same thing, you know, Robinhood made it easy for, you know, individual investors to start using options as well. So they get that high that, you know, they bet on a stock and wow, it exploded. And they're like, let me use options again to bet on that stock. And then they lose all their money and they're in a hole.
And also all the stimulus checks. People were home.
Yeah.
People were home and they weren't working. You know, I say all the time they needed some action. They needed something to do. They were furloughed, especially our generation. They had that, oh, apps, let's gamble. It was easy.
In Jordan and Scott, I don't want to steal your thunder, but I know I heard it from some of these individuals. Well, it was free money anyway. It just ended up in my checking account. So not like I actually went out and worked for it. So they felt comfortable with, okay, I can be a little bit speculative with that money. And in some cases, they lost it all, right?
And
Yeah,
you know, I'm glad
easily.
you guys are bringing this up because and you do practice what you preach. Because I have to give you both credit. I remember Scott came home one night and told me the two of you both invested $250 in some Bitcoin that was trading at literally a fraction of the penny. And I could picture Scott sitting in the den, like doing the math, saying, well, you don't understand. If it goes to a penny, I'm going to have $5 million. Some insane number. And but to both of your credit, you only invested $250 each. And by the way, how's that investment going? I'm just curious.
It's gone. That's a wash. But that's what I'm saying. Like, it's okay. Like, to me, it's like, okay, I have a little action in it, whatever. But it's not. It's money that it would have been spent on, you know, some type of live. It's one less round of golf I get to play.
There you go.
So it's
Look, and to be fair to both of
I'd have a
you,
little fun, so.
both myself and Michael tell a client, look, if you want to speculate with some money, and maybe we're dealing with a larger number, but hey, carve that out, make that your play money, make that have fun, go out there, trade some stocks, but your serious long-term money, that's our responsibility, right? So we do encourage people, you know, I want to play a little bit, go ahead. You can't be always hiding everything under the mattress.
Yeah, exactly. You know, you gotta have a little fun. Scott and I do. You gotta have a little fun, take some gambles on some of these stocks, but it's just understanding your risk. Understanding, I look at it as lost money. I invested, and if it goes up, great. If it goes down, that was my anticipation.
Jordan, let me ask you this. You know, you and Jen, you know, you're a lawyer, she's a CPA, you both had good educations, you both have pretty good earning potential. I know you sit in a lot of people's homes and you prepare their wills for young couples. What do you say to a couple who, you know, maybe they're a two-family income now, but when they start a family, they might become a one-family income? You know, what type of stresses are those folks feeling who you know might not even have the same advantages that you guys have, who just in a different, you know, economic stratosphere?
You nailed it. You nailed it. You took the words out of my mouth. Is that some of these people aren't in a position where grandma and grandpa, when kids are born, are going to be able to help. They're going to be able to help financially. They're going to be able to babysit. The conversations that I usually have with these people are pretty much what I tell them is, I'm not a financial advisor. I'm not going to tell you how to spend your money, but it comes back to discipline. I tell them, I say, you know, always have that safety net. I always say, keep, you know, 2 months mortgage set aside. If you could do that now while you still have those two incomes, put some of the money away just in case something were to happen, to do it. I tell people to take money out of savings accounts, and if they're going to keep them in savings accounts, put them in money market accounts. But it comes back to, again, is that I'm not a financial advisor. You know, I try to guide as much as I can without overstepping my financial literacy. Most of my conversations go along about liability protecting, and with young couples, their biggest concern is not usually finances. It's usually what happens to their kids in the event something were to happen to the both of them. Most of our conversations go towards guardianship rather than finances, but sometimes it does come up, and we will discuss about, you know, discipline.
Hey, Jordan, let me throw a little bit of a curveball your way. I know we share some mutual clients with your firm, and one of the areas in particular is when one of our clients pass away, they have to probate the estate.
Yep.
What we're finding is that the children are, in some cases, inheriting some pretty significant assets. And children could be, I don't mean 12-year-olds, I mean people 25, 35, 40 years old, where they've struggled for a long time meeting their mortgage payments and maybe trying to pay back college loans. And all of a sudden, it's like, it's sad that a parent had to pass away, but all of a sudden they're coming into some pretty significant amounts of dollars. What's your experience with that? What kind of advice are you giving them? What are you seeing?
That's a great question. This is, I wouldn't say all the times, but a lot of the times it's children in their 40s, 50s coming into money. They've have had debt, college loans still, mortgages, and they're coming into a substantial amount of money, and they're always so quick to pay off their debts. So hypothetically, somebody comes into, $2 million, they have it spent, $1 million spent of it in their head before the probate's even complete. Most of my advice to them is go hire a financial advisor. Go meet with people. We recommend a lot of people to Lebenthal, right? We do a lot of work together, and we tell them to go get expert advice. Don't spend anything until you have the opportunity to talk to somebody who knows more. This is usually when I pick up the phone and I call Scott or Michael and say, hey, I have somebody coming your way, or, but I've seen a lot of people, now to your point, spend $4 or $5 million before it's ever hit their account. And then they're back in the same position where they are, and they think the only thing to do is get into more debt. It becomes a cycle. It's not an easy conversation to have with somebody, to tell them to, not take the money and pay off their mortgage right away when they have had it.
And leading to your point, sorry, but it's sometimes not what they want to hear, right?
No. Yeah. What I tell people all the time too, with those conversations and with my job, I had somebody in earlier and I said, listen, my job is to prepare for the 2%. And when I say my job is to prepare for the 2%, the 2% of that's not going to happen. Our jobs, right, are to prepare for the worst and hope for the best. When I have a client and we discuss their assets and their estate plan, most of the conversation is, if everything goes wrong, how do we make sure your wishes are still the best upheld? And that's kind of, some of those tough conversations, especially talking to people about what they should do with their money. It comes a lot of conversations. We're doing a lot of Medicaid planning now, and having to talk to people about, not having access to their money and moving them into irrevocable trust, and, talking to elderly people, or, about their estate plan and how to move their money around it's not usually easy conversations, but they're conversations that need to happen in order for us to give, the best advice we can.
And Jordan, just getting back to, your peer group, yours is Scott's age group. Do you guys worry about the sustainability of the middle class on Long Island? About people your age wanting to stay on Long Island, or not being able to afford to stay on Long Island?
100%. Long Island, I call Long Island Disney World. Because when people watch the news, and I have these conversations with my parents who are in a different generation, grandparents, and they hear about national averages and things coming down, I'm like, it's just not going to be Long Island. It is I say you step out of the house, you spend $100. And now I started saying you walk out of the house in Long Island, you're spending $200. It's tough, especially when, my salary out of law school, my first salary out of law school, I think was $50,000. And that's with a law degree. I can't sit here and say it could be easy if I was by myself. It wouldn't be. It's not going to be self-sustaining. I have a lot of friends that have moved to Florida, because you take that same salary down there with the education, and they got the no state income tax, and things they say are a little cheaper, but it's difficult. It's very difficult.
So just kind of changing, we're starting to run a little bit out of time, but do you guys, silly question, I realize I'm sure it's not your first thought in the morning, but do you guys worry about things like how large a national debt we have today, whether Social Security is even going to be around when you're theoretically eligible for it? I quite honestly never thought in my life I'd ever get, when I was your age, I didn't even think about it because there's no way I'll be around to collect it. But all of a sudden that's kind of sneaking up on me. I want to talk about you, Mike. You're even older than I am. But
By a week.
you guys think about this stuff at all?
I do. Given the nature of my business and talking about it a lot, I think about it regularly. What about you, Scott?
I think about it more. I mean, back when, 5 years ago, before, or longer than that, since I joined the company, I didn't think about it at all. But yeah, I don't think most of my friends are thinking about it because they're not in the business of, I want to say thinking about it, but no one's giving it a second thought unless you're working in finance or you're an attorney, I feel like, and realizing, oh yeah, that may be an issue.
I think I'm more concerned about the value of the US dollar. When it comes to inflation and, a lot of the foreign obviously this is more I'm sure we could talk about this for hours, about the BRICS and, the price of gas and stuff like that. When you talk about the national debt, about how we're going to be able to import, export, and how those costs may get shifted down to us on a national level.
Yeah, again, we've been joking a lot, but you're definitely an old soul. But because I would agree with you, most 28-year-olds are not worrying about, the bricks. They're worrying about their fantasy football lineup for next Sunday, Jordan.
And maybe even know more about it, Mike. They'll recite to you the all-star team verbatim, but won't have a clue what our GDP is, or our GDP ratio to debt and things like that. So I'm just curious where your mindset is.
I'm trying to get to a 15 handicap this year in golf. That's my goal.
Well, you're thinking about it, so you got me beat right there. So you got me beat on that one.
That's kind of what's going through my head at this moment.
So Jordan, last question, just bring you back to reality. I remember when you had those jobs at a law school, and I know you hate, I don't want to use hate, that's a strong word. You weren't crazy about those jobs, and that's why we got you the introduction to Harold. So now here you are starting your career, still in the infancy of your career, and you work at a small hands-on law firm. You seem to do a lot of projection as a younger person. Truthfully, is this where you saw yourself? Because Dominick and I did see ourselves working for smaller companies or working for ourselves when we were your age. Did you see yourself the same way, or did you see yourself as part of corporate America?
No, I saw myself the same way. I wouldn't think, if it wasn't for your introduction and Harold taking a risk hiring me, that I would be here this quickly. I thought it would take me, a decade going through the big law firm life, clerking and stuff like that, to be able to get here. I didn't think I'd get here so quickly. I was not happy with my previous jobs. The greatest thing ever for my career was your introduction to Harold Balachi, because I don't know if he'll watch this, but I say it to him every single day. He understands me. He knows how to get the most out of me, which no employer has ever been able to do. He knows how I work, and he knows how to work to my strengths. And that's a good boss right there.
Well, Harold's a great advocate. Harold's a great partner for us, and believe me, he's a kindred spirit as well, because he's other old soul. So you guys were a perfect match. Jordan, thank you for your time this evening. We appreciate it.
Thank you for having
Jordan,
me.
I congratulate you on your success and your old school mentality, which is a compliment. God bless and wish you all the best luck in the world.
Thank you. You as well.
We are out of time for tonight, and we will be back next week with a new show on the Lebenthal Report. Have a good night, everybody.
Good night, all.
Good night.